Eric Muad with Muad.com with another mentorship video. What I wanted to do is discuss a method that I call the Muad Virgin Breakout, and you'll find more in-depth explanation by taking a look at the playlist on my YouTube channel. And this is the playlist right here. So it's got a couple of videos here, and it can be very useful in timing short-term entries for stocks that could have an explosive move. And so, just to summarize how this setup does present itself, let's take a look at an example here of what I'm talking about. So in summary, what this method does, it uses the 50-day moving average and the 200-day moving average. Remember, this is just a method for short-term trading. So the 200-day moving average. So this is a method that uses commonly found moving averages. And so how you do this is you're pretty much looking for an area in the stocks trading as the moving averages. They usually have the trending up and down, but what you're looking for is flat movement. For example, let's say this is the 200-day. So let me hold on here, let me change colors. So this is the 200-day moving average as an example, the black line. And let's see here what color we're gonna use for the 50-day. Let's go with blue. So blue, if the moving average, let's say, has been doing something like this and is now flat. Now, even though this is not as flat as you'd like it in my example, but just assume this is flat. Both of these lines are flat after being, either they've been trending higher. In most cases, actually, both moving averages should be trending lower, and at some point they stop going down, and both of them are flat. So that's the key. Both moving averages have stayed flat. So the 200-day moving average is flat. Let's call it something like that. And then the 50 has also gone flat. Let's call it something like that. And again, so this is the lower moving averages is the 50-day moving average. So how this method works is very simple. The only way, and it's the only way, that this moving average can move higher, and the only way that the 200-day moving average can move higher, there's only one way. The only way these two moving averages trend to the upside is by price exploding. I hope that makes sense. So the moving averages are flat, and the only way they can move higher is by the price exploding. So you take advantage of this. And how do you do this? It's very simple. What you do is figure out what is the highest daily closing high. So let's say the stock was trading, let's call it something like that, made a high on a daily closing basis, settled down. So what you want to do is figure out what the highest daily close was here. And let's say the highest daily close there was, let's call it $11, right? So you set an alert at $11, which is this close right here. And the next time you see that the stock is breaking out above the $10 area, which means it is attempting to probe higher prices, then that would suggest that the price is now potentially going to influence the 50-day moving average and also influence the 200-day moving average by moving higher. And also eventually you want to see that there's potentially going to be a crossover. So that crossover can only take place if, so this crossover here can only take place if the price explodes. Keep in mind, the theory here is very simple. We start off with flat moving averages, and we know the only way they can go higher is with a price explosion. So a flat 200-day moving average, and also we begin with a flat 50-day moving average, knowing that the only way these moving averages can move higher is with a price advance to the upside, which would bring the averages higher. And so you use the highest daily closing high during the period when the moving averages were flat. And that's a key distinction here. So I know it gets very confusing, But what this talks about here is very simple. Your buy point is the highest daily closing high while the moving averages were flat. So the highest daily close while the moving averages were flat is what you use as your buy point. Here we assume that $11 was the highest daily closing high while the moving averages were flat. Hope that makes sense. And I call that a flat buy point or a flat pivot. In other words, the buy point is the highest close when the moving averages are flat. And again, go back to the video series called the Moi the Virgin Breakout, which talks about this and gives lots of examples. So let's summarize this yet again. And it's a very simple strategy. So we got moving average comes here, and let me change this a little bit, and we see that it is forming a straight line. So that's the moving average, and that's the, for example, the 200-day moving average. And then we also have the 50-day moving average, and of course this is oversimplification, but just trying to explain this visually, which has been going lower, and at some point it stops going lower and forms a flat 50-day moving average. So we figure out what the highest daily closing high, let's say somewhere there, which within the period when both of them were flat. And that's a key distinction. So you have to figure out what was the highest daily closing high during this period here when you got your moving averages flat, right? And I'll show you a couple of examples. And so the next time you see that the price is advancing above this daily closing high, any movement above that previous daily closing high, you can use that as a reason to go along the stock. So any breakout, see here, change colors a little bit, any breakout above the previous daily closing high during the period when the moving averages were flat is your buy point. Reason being that you are anticipating with the breakout that the price is gonna advance the moving averages higher. And the only way that moving average can be influenced to the upside is with a price advance. And it is also a way to anticipate and take advantage of a future crossover between the 200-day moving average and the 50-day moving average. So you're also anticipating this crossover. And the only way that crossover can take place while prices are flat is by a strong price advance. Let's take a look at some examples. Okay, let's begin by taking a look at the VIX. And here the reason why I'm actually making this video is because you might notice, maybe not, but right now in the current market the VIX did have a flat 200-day moving average, and here we have a flat 50-day moving average. So the buy point was this daily closing high there at about I think was 15.95, and you can see that since the breakout already we are seeing a good advance in the VIX. Since the breakout above that highest daily, remember this highest daily closing high is taking place while both the 200-day moving average and the 50-day moving average are flat. And you see the only way this can eventually lead to a crossover is if both move higher, and also the only way that that can happen is with a strong price movement. So in the current market there is that setup that could actually suggest that at this rate we might see an explosion in price. Take a look at the previous movement higher. There was a period a while back where we had a flat, generally flat 200-day moving average and a flat 50-day moving average. Remember, it cannot be flat generally or specifically, but it's generally flat. And so you use the highest daily closing high, which was there. And this is a perfect example of what happened here, because the only way after being flat that the moving averages can explode to the upside, and also the only way we can get a future crossover in the 50-day moving average above the 200-day moving average, the only way is with a price breakout. And you see what happened here. There was a strong explosion in price. The VIX jumped from under 20 all the way to the highs here of 52. And so all that one needed to do is understand that the moving averages were flat. With a breakout, there's a potential for extreme price advance so that the moving averages can move higher and cross over. Hope that makes sense. Let's take a look at the current market here. I'll show you what I'm talking about. Live example. So this is the URA. And number one, the one thing I want to point out here is we can see that the URA has a possibility of breaking out to 3-year highs, which is what we are looking for. So there's that possibility here for a breakout. And we see that the main MACD is already trading at 3-year highs, which is what we want. And the secondary MACD could also be moving to 3-year highs. So this one does meet the minimum requirement for an instrument to watch. So we're already interested in this. But really also, if we take a look at let's take a look here at the weekly, another example, the possibility that there could be a breakout here or a crossover between the 13-week moving average and the 34-week moving average also suggests that maybe we should continue watching this, because should this instrument break out above the recent weekly closing high, it could cross over. Now, I want to point out something here, but I don't want to confuse you, because here we also have a flat 33-week moving average. So the 33-week moving average is flat, and this is something that you can also use. Because the 33-week moving average is flat, it suggests that if the moving averages is to start coiling higher, and of course it's a big if, we don't know for a fact, but if it is to coil to the upside, now that it is flat, the only way this can happen is with a price advance. So you can also use this on weekly charts, is what I'm getting at. Whenever you see flat moving averages, understand that the only way the flat moving averages can move or change direction is with a price movement. Here the moving average is generally flat, and which suggests that the only way this can start coiling to the upside is with a strong price move. But now if you take a look at the daily, which is what we are concentrating on here, is you'll notice that right now there is what seems like the beginning of the formation of a potential flat 200-day moving average and the potential to form a flat 50-day moving average right here. So since we are looking for the highest daily closing low or daily closing high when both moving averages are flat, which means that we now, so right now, generally speaking, you got what looks like flat 50-day moving average and a flat 200-day moving average. So this daily closing high right there just under 1550 is our buy point. So what we do, we set an alert that any breakout above this price could be triggered as a buy point. So you don't buy this until you see the price breakout, because if the price was to break out, that would suggest that now both moving averages could start being influenced to the upside. And so what we are suggesting here is with a breakout, the 50-day, the 200-day moving average can coil higher, and also we might see an explosion also in the 50-day moving average. So this is a very simple strategy. You wait for a move above this recent daily closing high. Now, let me show you another example here. Is KOL. And maybe you can see this clearly, but you can see here right now we are looking at what looks like the 200-day moving average is going flat. So because that, now I also do need to stress this. Sometimes you'll find that only one of your moving averages is, so only one of your moving averages is moving high. Sometimes both moving averages are flat. So let me stress that. It is best if you can find both moving averages as being flat. So let me stress that. The best scenario is when you got both moving averages as being flat. So you got your 200-day moving average as being flat, your 200-day moving average as being flat, and or also your 50-day moving average, right? That's the best ideal situation, where you take the highest daily closing high. Sometimes the daily closing high can actually even be here, and I'll probably show you an example about that. But what I'm trying to say here is, keep in mind that sometimes you are only going to have one of the moving averages as being flat. And whenever you have one moving average which is flat, you can still use this method, because you take the highest daily closing high while the flat moving average was while the average was flat. So let's say if it's the 200-day moving average that is flat and the 50-day moving average is not flat, you use the highest daily closing high while the 200-day moving average was flat, and vice versa. In other words, if only the 50-day moving average is flat, then use the highest daily closing high while the 50-day moving average was flat. All right. So it's best when both of them are flat, okay? But sometimes only one of them is going to be flat. The point here is, you want to play the possibility that the moving average, after being going down for many months, sometimes many years, has gone flat, and that the possibility is that now the moving average wants to coil to the upside. The only way the moving average can coil to the upside is with a price move, and that price move is what we want to capture. So as an example here, we have a flat 200-day moving average, but you can see that the 50-day moving average is not flat. It's actually beginning to coil higher. So what you do, you take this daily closing high. Why? Because it is the highest daily closing high during the period when the 200-day moving average is flat. So at any rate, any breakout above the recent daily closing high, so any breakout here above the recent daily closing high, can be used as your trigger point. So here the daily closing high is somewhere, let's call it 8.8, somewhere around here. So that's the current daily closing high. Any breakout above that price is a good breakout to consider going long, because that would suggest that the stock is now wanting to influence its 50-day move, its 200-day moving average, by moving higher. So you're anticipating that the moving average, after coming down, is now going flat, and a breakout might suggest that now it wants to go higher, and so you want to play the momentum to the upside. Now let me show you another example in the current market that actually played out well, and its recent movement in the gold stocks. Some of them do show the same scenario. Take a look at GPL, and here we can see that you got, see here, we got a flat 50-day moving average, flat 200-day moving average. So you take the highest daily closing high, which is there, and once the stock moved above that, that was your trigger to go long. And you can see that that was with a price breakout that was good for a very successful move. So this breakout here above the previous daily closing high, where both moving averages were flat, that's your buy point, and that's your entry. And you can see the price did explode, and you got now both moving averages pointing higher. We also have a crossover, so which means that that was the perfect time to go long. And since then the price has moved from about, let's call it 55 cents, to a high of $2.20. That's a huge move. All right, so that's what the Moa the Virgin breakout is. It's for short-term entry. Here the stock has moved since the breakout. The stock has moved over a couple of weeks. So this breakout here, the stock has moved higher over a period of couple of weeks, and let's call it, so we got a movement here, 1 month, second month, and within 3 months the stock has gone to record a very strong move. Let's take a look at another example here, EXK. So again, if you're looking or if you observe that one of the stocks you are watching has this type of a look and feel, then this is what you'll be looking for. Sometimes you don't have to go hunting for this setup. If you see it, you can take advantage of it. So the way I look at this is, while you're going through scanning for charts, if you observe something that looks similar to this, is when you take advantage of it. No need to stress yourself in trying to find these types of ideas, in my opinion. But here we have a period where we have a flat right there. The moving average was flat, which is the 200-day moving average. Take note that the 50-day was not flat. It was actually already coiling higher. But think of it this way. So this setup here, think of this setup here this way. So think of it this way. We got a flat. We got a daily closing high. See here, let me change something here. And then you got a flat 200-day moving average, which is flat. And then you have your 50-day moving average, which is already coiling to the upside. Something like, so the 50-day moving average is already coiling higher. So this is your buy point, the highest daily closing high, while the 200-day moving average was flat. Now keep in mind, visually, the only way these moving averages can change direction, and it is the only way, is by price exploding. The only way we can get a crossover, is what I'm trying to say, is by this moving higher and by this coiling to the upside. So what you're doing in essence is you are anticipating this move in the moving averages. And the way you know that there's a possibility that the moving averages might start moving higher is with a price breakout. So you buy when the price explodes to the upside, but you have to be patient here. You wait for the price breakout right there. And pretty much that's what we are looking for. So back to our example, and again, let's do this again. So you got, let's see here, you got your flat 200-day moving average right there. You have an already upwards trending 50-day moving average. So this is your moving average. The only way this can cross over is with a price explosion. And so what you do, you find out what the daily closing high while the 200-day flat was, and once it breaks out, that breakout here was your buy point. And of course, the price explosion is what moved the moving averages higher, and we have a crossover after the price explosion. So you are anticipating the moving averages exploding to the upside. You are also anticipating that the 200-day moving average, which was flat, is also going to coil to the upside, and you take advantage of the price movement because you get this nice alpha, this nice movement. And here we see the prices move from $1.80 to about $4.20 in about just 2 months. So it's for a short-term move, an explosive move at that. Let's take a look at one more, RIC. And again, check out the YouTube playlist where I discuss this. Now here we can see that the 200-day moving average, that the moving average was flat for many months, generally speaking, somewhere there. And you have your 50-day moving average, which was already coiling to the upside over a period of many months, just slightly coiling, moving higher. So the only way we get this crossover is by a price explosion. Now I do concede that some of the breakouts were not successful. For example, this breakout was not successful. The stock would come and test that and fail. But finally, you get a quality breakout here, because once it broke out, remember, this is the highest daily closing high while the moving average is flat during this period. So that's the period when the moving average is flat all these months the moving average was flat. It recorded a daily closing high here, and finally it broke out above that. So you buy the breakout, because the breakout might suggest that now the moving averages are gonna cross over, and the moving averages have a chance of pointing to the upside, which is exactly what happened. So you buy that more divergent breakout once it moves above the previous daily closing high. In this example, we see that the price did move from about $3.75 to the high here, currently under $9, over a period of 1, 2, 3, 4 months. So it was a swing trade, and the reason why we bought this is because we were playing the crossover possibility between the moving averages, and the only way this can take place is with a strong move in price. Otherwise, for more into this, I encourage you to go and check out this playlist on my YouTube channel, which goes into more depth, more examples as to how you can use this ultimate that goes into depth about this strategy and this setup. Eric Muaded, Muaded.com. As always, good luck, peace, and blessings. E. I see. S.